Are you ready to take your business to the next level? Every day there are countless books and articles that are published offering the key on how to make your business a success. It's easy to feel overwhelmed trying to keep up and run your business. That's why Deb Creer created the Business Power Hour. Keep up on the latest trends, best practices, and techniques for how to make your business a success. Let the Business Power Hour do the heavy work for you.
Good morning, good morning. I am Deb Creer, and I am passionate about giving professionals the tools that they need to make themselves and their businesses as successful as possible. And I am so excited today because what makes a business successful is obviously us, all of that good stuff, but takes money. And so we're going to talk with a great guest today who's going to help us in making money in a lot of ways passively and able to fund not just our business, but our fun too, right? So please join me in welcoming Lane Kawaoka today to our program today. Welcome, Lane. How are you?
Yeah, thanks for having me. Aloha, everybody. Not to
I
forget.
know Lane is in Hawaii, and I told him not to tell me what the temperature was there because it's pretty nippy here in Atlanta. So Lane, let me tell folks just a little bit about you, and then we'll jump into this. So Lane Kawaoka owns over 10,000 rental units and leads the Hui, did I say that right? Hui Deal Pipeline Club, which has acquired over $2.1 billion of real estate by syndicating 200 million, more than 200 million, of private equity since 2016. He has returned over $45 million to his investors in distributions. He is the founder of the Wealth Elevator. Lane uses his engineering degree to reverse engineer wealth building strategies the rich use in the top 50 investing podcast, The Wealth Elevator. He is also the author of The Wealth Elevator, Real Estate Syndications, Accredited Investor Banking, and Tax Strategies for First-Gen Millionaires. Holy schmoly, what a great bio. And again, Lane, welcome.
Hey, thanks for having me. Yeah, let's get into it, right? I think that like a lot of people, they want to understand financial independence. I think this is going to be more dedicated to the business owners out there who already, aren't broke, right? I mean, this is not the Dave Ramsey, Cecil Orman show on here today.
Right. Well, tell folks just a little bit about how it is that you got to where you are today.
Yeah, so I went to school to be an engineer because I didn't want to go to doctorate or master's. I wanted to get with the least amount of education to get the highest amount of pay. And I started to work for the man. Graduated in 2007 out of college and made a pretty good salary, but didn't really care for my job too much. But on this time, still on this linear path of buying a house to live in, which I don't necessarily agree with for most people out there, especially the people who are good savers, right, and make good salaries like myself. But I bought a house to live in a couple of years later, and because I was traveling all over for work at the time and never home, I just decided on a whim to rent it out. And that was kind of where I went down this alternative financial path and never looked back.
I love it. And now this is all that you do.
Yeah. I mean, there's a lot of steps in between, right? Like that first rental bought in 2009, by 2000, bought a duplex a couple years later, right? Because I don't flip houses. I don't wholesale houses, right? To me, that's what you do when you don't have too much money, right? And your job is real estate.
And it's just kind of a churn.
Right. You're trading time for money. Like some businesses are like that. But I had a good paying engineering job and I was really good at saving my money. And whether, you're good at saving your money or you have a good business that churns out multiple six figures of profits every year or even more, right? The idea is you diversify out and get exposure to real estate. We'll talk about taxes later on, I'm sure. But eventually I had 11 of these little rental properties in 2015. So just kept buying more and more properties. And that was kind of when I became an accredited investor. So accredited investor, people can look up the definition. But basically, you got $1 million net worth or greater. And now you get access to more of these syndicated country club type of deals, buying better assets, not little single family homes, And that was kind of where I found myself around 2016, interacting with other accredited investors, right? No longer going to the little real estate club with wholesalers and flippers, but started to uncover this world that I think we'll talk about today of investing directly in larger commercial deals, the tax benefits that you get from it to offset your taxes, and then a little bit of life insurance, infinite banking. And this trifecta that I write about in my book, The Wealth Elevator, is pretty powerful, pretty powerful stuff.
I love it. Now, the first question that I'm sure many people ask you is, but I don't want to manage those properties. I don't want to be the person they call at 2:00 in the morning when their toilet backs up. So explain to us a little bit more about this.
Yeah, I mean, when I first started buying rental properties is I had a full-time engineering job. And I get it. It's my time was better spent trying to get promotions or for people listening, working their business. So paying a property manager 10% of the rents every month made total sense to me. Now, there's a lot of people out there that think that's a lot of money for nothing, and
Until
that's
they
fine,
get
right?
the call at 3:00 in the morning to fix
Yeah.
somebody's toilet.
I mean, when I was in college, there was like the landlord that would come and clean, unclog our toilet on a Saturday night, and they drive in with their Mercedes. But man, like that was like the wrong way to do it, right? It's just like a business. Like once you're making revenue, you find the lower hourly rate tasks that you could delegate, and that's how you scale. Right? Simple as that. Property management and just doing it, is no different. But also, by doing the property management yourself, you take on a lot of legal liability, and you extend that even more. Where when you become now an accredited investor, net worth $1 million or greater, you're even more of a target.
Right.
And this is where in 2016, I started to interact with other accredited investors that, did the landlording thing or property management, right? But they owned little rental properties directly. Sure, in these LLCs, whatever, right? But they were still the direct owner and managing partner. And what I realized is a lot of these guys were trading up. They're selling the little rental properties and getting more involved into larger syndication deals where a general partner operated and they got paid carried interest, right? They got paid when the deal went better, but also through this legal structure, they were LPs, limited partners, limited liability.
Okay.
Not a lawyer, not giving any tax or legal advice here today, but, a lot less legal liability, if not any, when you're in that type of position.
Right. Yeah, I'm going to use my toilet example again. If you're managing it yourself and the toilet backs up and maybe their clothes get ruined, then you're on the hook for that. But if you have a property manager, they have the right insurance to cover all of that.
Yeah, there's another layer in the process, right? But when you're a passive investor, an LP in that management team or that management structure, you're even another rung remove, right? You're not even in the general partnership there.
Right.
But I didn't even realize that this was a thing, right? I mean, we always ask people like, how many accredited investor connections do you know? Right. At that time, my parents never owned rental properties and I didn't have any rich uncles. So
Right.
I just knew to buy little rental properties, bought 11 of them. And then I ran into the scale issue. Most of my clients today, they aspire to having $10,000 of passive income per month.
And that's quite a few properties.
Yeah, exactly. And back then with 11 properties at a few $100s of cash flow per property, that's times 11, that's $3,000 a month. That's great. Don't get me wrong, right? That's like a third paycheck a month. But with 11 properties, I had maybe an eviction or two every single year, some kind of big catastrophe that happened, tree falling in a house, washout in the basement, etc.
Right.
I mean, not a problem because the property management takes care of it. But you, the owner, at the end of the day, the buck stops with you. So you have to kind of keep them accountable.
Right.
But that's with 11 properties for $3,000 a month, right? If you multiply that by 3 or 4 to get to your $10,000 level, now you're talking about an eviction every other week and some kind of big catastrophe happening on a weekly basis, right?
Right.
And it just becomes not scalable, right? So, there becomes a switch. And this is kind of, in my book, The Wealth Elevator, we have this kind of construct of there's a building and there's different levels. There's, floors. The elevator kind of moves you up and down quicker, expedites you through it. but nobody told me that there was different paradigms to the wealth building journey. I think we're all inundated with real basic financial tips here or there, and very random ones, right? Especially in the world of TikTok and YouTube
Right.
Shorts.
Bitcoin. Oy.
Yeah, I mean, when not saying it's a bad investment or good investment, right? But at what point in your wealth building journey, where's your net worth? Does it make sense for you? And what I write about in the book is, I just tell my story, right? Going through these different floors myself. To me, the book is not written for people in credit card debt, right?
Right.
Like if that's you,
Right. You have to have money to be investing.
right. You got to keep a budget. Maybe read Dave Ramsey, Caesar Orman. Excuse me. But, to me, the wealth elevator building starts on the first floor, and that's where I was. Out of college, I didn't have too much student debt. I paid it off pretty quickly, but had a good income. And the name of the game when you're a non-accredited investor, to me, is buy little rental properties, build up that base. But as soon as you're getting on the road to accredited investor status, or, you make over $200,000 a year at your day job or your business, step up to the bigger things and get going on those higher rungs.
Right.
If you're thinking of a bike, get to the higher gears. And then, we can talk more about like what happens after the third floor, etc. But, I just wanted to introduce this framework of there's different stages of the wealth building game with different strategies and different, tax strategies too in them. And it's just not like a one size fits all plan.
And what I like about your book is you don't have to be the person with $1 million of income that you can be doing this. You can start at very low. And I was sharing with you that I am mentoring a student at the University of Colorado. She is a freshman, so I think she's 19 years old, and she's already talking about how smart real estate investing is. I was just dumbfounded that and she's not a business major. She might end up being a business major, but it wasn't that she just knew that this was something. And so, she probably can't do it right now because she is in school. But she's planning for it. And, I think that's one of the biggest things that is, the issue with so many people who have so much debt. I mean, we're talking about that. They always think, I'll do it at some point. Or I have to have the $1 million to do it. And they don't realize it really doesn't take a whole lot of money. And it does take money, but it doesn't take million to get started.
Right. I mean, the nice thing about real estate is you use debt, right? And that's why the banks like to lend on this stuff. Is a very, hard, solid asset that provides utility in the world, as opposed to Bitcoin, right? Like, it's utility there.
Coin is,
Yeah. I mean, I like the investment, don't get me wrong, but, it doesn't provide utility in the world like real estate does, where you live in the thing. But yeah, to get started on the first floor of the wealth elevator, actually, that's how I got started with this. In 2016, I started my podcast, and we started to, I just would tell my story. And eventually we created an e-course, a community of people buying little rental properties and going from there. And what I started to do was, we kind of obviously moved on because, became an accredited investor, and our community aged and got wealthier and older, right? But, a lot of that's still on the website for free. We just give it away for free. If you go to thewealthelevator.com/turnkey, we have this e-course on how to buy a little remote rental property. Usually the prototype is you find the market in a red state, right? Because traditionally when you're a landlord, you want to be on the landlord's side. Typically those states are a little bit better, especially when we focus on the lower middle class funnel.
Right.
And then we also try to find properties that hit a 1% rent to value ratio better. So, if you live in California, that ain't gonna happen, right? Hawaii, like your rent to value ratios are like less than 0.5%. So you find that by taking the monthly rents divided by the purchase price.
Ah, okay.
So
yeah, and it just costs a lot to purchase.
It's more relative. Yes, you're right. It is way more expensive in the West Coast.
Right. But the salaries are going to match that. So
yeah. But it's the price per ratio of the rental dollars. How much dollars can you pull out of that thing as rental? So prototype again would be like $100,000 house that rents for $1,000 a month. So 1,000 divided by 100
Mhm.
grand is 1%,
Mhm.
right? Check the box there. Of course, you got to, do the e-course, and we have like an
Mhm.
underwriting sheet to
Mhm.
dive more into, but real
Mhm.
high level on this podcast here. That's kind of what you look for. And with real estate, you typically can get a, 80%, 70% loan to value loan on it. So you got to come in with
You
25,
gotta have
30
something to
grand.
start. Mhm.
Yeah, but it's not $1 million,
Mhm.
like you
Mhm.
said.
Right, right. So, I mean, you were talking about houses, single family houses and duplexes. What about multifamily properties? Is that something, so maybe you've got 10. I mean, there's a development by us, and I haven't looked it up, but I'm pretty sure there's got to be 2,000 units there. It is big. So, and clearly that's a totally different realm, but what about 10 unit apartment units, things like that? Are those also, something that is included in this?
Um, I'll be honest, it's a bit of a no man's land
Okay.
in that area, right? Like you wanna like the nice thing about staying the 4 units and below is you can take advantage of nice Fannie Mae financing.
Okay.
You go above that 4 units, you're no man's land in terms of lending.
Ah,
And then you also don't have the economies of scale,
right.
right? Like, I mean, this is why we try to target things at very least 50, 60 units, because at that point you can have a leasing agent in the property at all times. Commercial property managers are a lot more sophisticated than your residential property managers. Um, and part of that is the advantage of they're physically there, right? They don't have to spend 80% of the day in their car driving from property to property. The other thing there is, um, you know, a lot of the costs, like if people are landlords now, right, you probably get killed with the plumber comes out, they got to charge you a mold fee, but they just get into the services.
And they're looking at everything and they're thinking, you have money, so I can charge you a lot.
Yeah, yeah. And, I think you're a rich landlord, which you're probably not. I'm just trying to get by. But with, when you get above 100 units, now you can afford to have the scale where you can hire people on salary.
Right. Yeah, you've got plumber on the spot, in essence.
Yeah. And an HVAC guy, maybe get him HVAC trained. So the leasing agent and the handyman stuff, they kind of work in tandem. So this is just one of many, many ways that commercial properties on that larger scale is much bigger, is much better from economies of scale. And you get access to better vendors than the mom and pop HVAC guy who's using the tool truck on the weekend to do side jobs, right? With not licensed, not insured, not bonded. But this is the problem here is like, well, how does the average Joe access these high quality commercial assets? You could access them through a REIT, but
Right.
it's just an institutionalized bloated product with a lot of, how else do these big Wall Street companies make money, right? For you to get access to there, you're paying them an arm and a leg. I mean, no different than like Blackstone's, like,
Right. You got to have the million to start.
well, yeah, you got the buy-in is a lot bigger. You're exactly right. Yeah, that's for sure. And also the fee structure that they're taking, right? They're not doing it for free,
Right.
right? They kind of got you over a barrel. So this isn't where in 2016 I realized like there's kind of a middle road here. Like wealthy accredited investors could kind of team up and maybe 50 or 100 of them go in and buy that 300 unit apartment complex in a syndication model. Of course you have to have the proper paperwork, right? Lawyers involved, but this created this maybe ecosystem where investors would, invest in that apartment and then they could diversify into all these different deals, build their portfolio with dozens and dozens of projects of exposure, limited partnership exposure to all these projects and get the tax benefits. And then now it also opened up the ability to get outside of the asset class, buy self-storage, mobile home parks, maybe even buying businesses, right? We've also actually teamed up with other business owners to buy them out or partner with them on future acquisitions, right? So it's just this model for capital formation can be used to, magnify what people already do. But what I would say is like start off with the basics, right? Apartment building is probably the simplest thing. And most people, generally speaking, you don't have to argue them blue in the face that it is, something that we're going to be needing more of in the future. And then maybe we'll time to get into the tax benefits now, right? Like with a little single family home, you can deduct 1/27th of the building improvement every year. It usually is enough to offset your income from that property, making it essentially tax-free in a way. But with these commercial properties, these syndications, they're large enough where you can pay for a little $5,000, $10,000 cost segregation study. All this does is now allows you to take advantage of 100% bonus depreciation laws that got reenacted with Trump. And now you're able to drastically increase the amount of depreciation can pull from the asset in the beginning. So this now allows investors the ability to do different manipulations with their income very legally. But it's something that not a lot of people talk about. I mean, if your CPA is somebody who's like, well, the only thing you can do is contribute to your 401k, that's nonsense. That's just deferring your taxes. You're going to have to pay the piper at some point. And what we're talking about is, lowering your adjusted gross income to, usually you try and sharpshoot it. So you don't want to drive it down to zero because, up below $200,000, $300,000 of income per year, you don't pay too much taxes. But definitely for some people out there who make $500, $1 million or more per year, you want to get yourself down to maybe 300 or 400.
Right.
Using
and
real
again,
estate.
it's totally legal to be able to do that.
Yeah. And then you get in, this is where we've created a bit of an ecosystem, right? Like people who invest in apartments typically are open-minded and start exploring different avenues, such as investing in oil and gas for the tax benefits there. And you start to realize, this is where I started to realize, like, wait a minute, like a lot of these things are very simple to do that the average guy, could implement themselves. And yet it frustrated me that a lot of the things that people were doing, these best practices that I heard from all these, people I respected, wealthy people, was the complete opposite of what we're all taught to do. Right. So that was kind of where the motivation for writing the Wealth Elevator and kind of, putting this in a concise book and saying, like, here's the reasons why. We're not giving you tax, legal, or investment advice,
Right.
of course.
That's what those other people are for.
Yeah. But the way I kind of put it is like, well, we're the ones who kind of fills your head with these ideas.
Right. And gives you the questions you should be asking, all of those things.
Right. And with AI now you can go talk with the intermediary without paying $600 an hour. But eventually, yes, you do have to work a professional to implement it who's going to back you on these strategies.
Right.
But what we realize is, unfortunately, 80% of our clients change their CPA because their CPAs have no clue.
Right.
All this stuff.
Yeah, because that's just not their area of expertise.
Yeah. What do they say? You never take financial advice from people who are financially free or a bean counter that just does taxes for the last 20 years.
Right.
Like, they obviously haven't figured it out.
Right. So, one of the things, and you talk about this, and you've got the resources for it, but what are some of the common investing traps that people fall into?
Investing in things where the numbers don't make sense. So I think a lot of people they hear real estate is a great place to invest and get some exposure into their portfolio. So they go buy a property in their local area. Most times, people listening, we tend to live in nice areas.
Right.
Right. Unfortunately, those are very rarely where the numbers make sense. So what I mean by that, like I said, if you live in Los Angeles, New York, Hawaii, Seattle, not gonna work, guys. Numbers aren't gonna work in these great places to visit and live, but just the numbers aren't gonna make sense. So you're always looking for like a blend, right? An emerging market with good economic drivers, population growth, but it needs to be in the right area. And if you live in one area and there's, I don't know, like 200 cities, like what are the chances of you being in the backyard of these good investments, right? Very small.
Right.
But unfortunately, people, especially new people, they go after comfort, right? They want to feel it, touch it, be around it.
I want to drive past my building.
Yeah, or what's worse, they want to show it off to their friends, right?
I own that. That's mine.
Yeah. But it's probably not the best place for your money. But you know what? Damn it, like real estate's such a good investment. Like, those strategies work, right? Not as well, right? But they work.
Maybe not as good as they could be, though, right?
Right. I mean, the strategy that you want to be doing is investing in the best places, right? And getting the best returns on your money, but also implementing value add strategies, right? So like, I mean, people in businesses, when you buy a business, there's things you should do to increase the revenue, maybe bring in new business lines, etc., or decrease expenses to increase the EBITDA. Just like in real estate, right? When we go into apartment, there's usually a 5-year business plan where we renovate units as they come up for vacancy. Nothing crazy, new appliances, new paint job,
paint, carpet,
washer dryer units, new playground equipment. Bump the rents up couple hundred bucks. But that increased revenue will happen over time. And you sell the asset through that value add process. So think of it kind of like a slow flip. But for the average listener out there, especially if you're new, you're not going to be the one implementing this, right? This is what you put in the hands of your general partner who's running the venture.
Right. You're not picking the paint colors, folks.
Yeah, I mean, neither do we, right? We just use the same damn thing every single time, right? Because we've hired a design firm and we just rinse, wash, repeat it, right? And that's what's nice about apartment investing. It's the same thing over and over again. Where single family homes, man, it's just they're all unique animals, and it's not repeatable. It's not a factory.
Right. So as we're recording this, it's early 2026. What are some of the best areas for investments right now? Like you said, California, Hawaii. No. I'm from Colorado. Seems pretty expensive there too. Where do you suggest folks are looking?
Yeah, I mean, depends on your strategy though, right? I mean, not saying those places are bad investments.
Might be a longer term type of thing.
I mean, I think for us is like when we enter an asset, we want to be able to hold on to the asset if we had to long term, right? So we want to pay our debt service, right? And but not to say that it's a bad strategy. Like I mean, like we tend to go into properties that are doing decent, right? 90% occupied or better.
Right.
Some people have the opposite strategy where they go after just totally dilapidated 0% occupied properties and they make a killing off of it. Just different risk profiles. But I mean, I think the essence of your question is like, where are like the hot spots? Well, I mean, I would just say, go look at the census data, look at the population growth. I mean, that's what's nice about investing in real estate. You're not allowed to insider trade with stock market information, but in this type of investing, you better try to get as much inside information as possible. And the drivers for real estate is something very conceptual. Population growth, economic growth.
Right.
I don't know exactly which one leads, but those are the drivers that you look for. And you look for those areas. Of course, you try and combo that with, you don't want to have a lot of new inventory coming on the market. I think like Austin and Phoenix right now today, a lot of new supply still hitting the market. Probably won't really recover in the next year or two. But what we do know is the peak of the market in commercial real estate was 2023. I think this a lot of people focuses on residential real estate. I don't do that, right? I don't follow that too much. It's a different dynamic. Commercial real estate, what we do, and in commercial real estate, you had a crash of the market, 2022 with
right. Yeah, all those places went vacant because of COVID.
Well, that's office, right? That's one sector. We don't really have the same dynamic.
But businesses closed. Just all sorts of things happened.
Yeah. I mean, I don't do office, but as a passive investor, I don't know if I would invest in office. I do think that there's a dynamic change in that usage of the asset class, but then that's one of the reasons why we do apartments, because people need a place to live.
Well, and maybe even more so now with remote work and things like that. And so they want a little bit better place. If they're going to be spending almost 24 hours a day there, they want it to be a little bit nicer.
Yeah, that certainly happened, I think, right after the pandemic, right? I also think another trend that's happening is like people can't afford to buy a house because interest rates are too high. The monthly payments are just too high for them. And Combine that with, the millennials, Gen Zers, right? This trend of being a little bit more location independent, being more flexible. To me, it's just mostly they just can't afford a house, right?
Right. And I mean, I was in my 30s before I got my first house. But that was also because I wasn't married until then. And I was like, oh, okay, now it's time to put down roots, right?
Yeah, yeah. And back then it was a trend of you'd stay at your company for a longer time. Now some people say you should really try to move every 2 to 3 years.
Right.
Jobs.
Yeah,
So,
and so somebody, yeah, they change jobs. Well, they may also very well be changing locations. It's easy to get out of a lease, harder to sell a house.
yeah, yeah. I will say like one trend that I look at is like the rich are getting richer and the poor are getting poorer.
Yeah. I was in the car earlier today and they were talking, like I said, I'm here in Atlanta, and they were talking about how people are having to lower income, which I know that's not who we're talking about, but they were saying, they're having to be in the long-term rental hotels because they can't afford to even rent an apartment. And to me, and what they were saying was obviously that's crazy because if at all possible, you want to buy so that you're at least owning something. But they were saying 80% of their salary was going to these hotels.
Yeah, yeah. I mean, general rule of thumb back in the day, they said 1/4 of your salary should go to your housing
Right.
expenses. I don't know where it came. Maybe last decade it changed into 1/3, but more and more, I think you're going to see that number creep up. I also think you're going to see smaller square footages, right? No longer
Right.
people
Oh yeah,
need
these big
bigger sizes.
mansions. I mean, like I live in a house that has 5 bedrooms. It's my husband and me. We don't need 5 bedrooms.
Right. Right. So yeah, you're gonna have your baby boomers downsize to apartments. The younger people can't afford it. So I think I'm bullish on the asset class of workforce housing apartments. So, most markets are things that rent for $800 or $1,200 a
Right.
month in rent, and that's why we choose to invest in that type of sector for those reasons provided. But that's you always have an investment thesis, right? You see what's coming ahead. You see what the dynamic is now. You don't know what's going to happen in macroeconomics, but with inflation, I think generally, inflation is going higher, so things are getting more expensive, and people's buying power or what they're making at their jobs isn't keeping up with that. So,
Right.
the rich are getting richer, the poor are getting poorer, and unfortunately, the middle class, the people probably listening to this podcast, are shrinking, and well, we got apartments for you guys to invest in, unless you read my book,
Right. 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 So, we mentioned that the book is The Wealth Elevator, and it is the concept of multiple levels. And in your book, you have 5. You've got basement, first floor, second floor, third floor, and then penthouse. So just kind of go through a little bit on what each of those floors means.
Yeah, basement level is you're in debt. You don't make less than $50,000, right? First floor is where I was out of college, made a good salary, but I didn't have net worth. I didn't have anything. So the name of the game was buying little rental properties until I became an accredited investor, net worth $1 million or greater, and that was kind of where I got rid of the single families and went in more of these syndication deals as a passive investor. Ultimately, started to run them myself, right? Because there's a big trust factor, and which is why I think you need an ecosystem, a community around you to help be more of a confident investor, which we try to help educate people today. People want a little guide on that, they can go to thewealthelevator.com/syndication. And but yeah, the second floor probably takes you up to anywhere from like 2.5 to 5 million net worth. The reason why it's a big range is it's mainly a mindset of you have enough to be able to really not work at that point. So for most people, it's if it's just you guys and you guys don't have kids, you don't have your kids are already gone, and you don't have to pay for college, then and in a relatively cheaper area like Georgia, 2.5 million may put you on that third floor.
Right. Right.
Family of
You live in
four.
California, you need more.
Yeah, you need more. The idea is once you hit a certain point, then you change your investment strategy and you go to a lot more safer, lower yielding things. But to do that, you need more money, right? So
Right.
there's kind of this inflection point if you're thinking of a curve, kind of, or like this idea of going into cruise control at that point. But the penthouse are for people who want to take their, really want to build their legacy, right? Because you have $2 to $4 million and you have a couple kids, you're just going to give it to them, and eventually, your kids will be fine, but the grandkids will just screw it all up probably.
Right. Yeah.
Like
Because
90,
their parents will have spent it.
their parents weren't investors like us, the first generation multimillionaires, and they won't know how to invest it. They'll be good worker bees, right? Traditionally, the people listening, your kids will go to good colleges, have very respectable careers, contributors to society, but the grandkids will grow up in an environment without scarcity. And unless, that's why we say, hey, bring your kids to the events, they can meet the other people on their level. And
Love that.
they a lot of this investing is about deal flow. There's all off market deals. There's no internet site for this stuff, right? I mean, if you want to invest from your computer and not talk to anybody, that's where Wall Street's got you over a barrel to access that stuff. What we do is we access what people call the primary market. You're getting in there on your own. If you want the sloppy secondary market, that's your entrance is through what Wall Street's products are or financial planners give you. But that's essentially, one way we cut costs and increase our returns by cutting out the middlemen. But yeah, like a lot of people, I mean, unless there's a concept of if you're not growing, you're shrinking. You're not moving forward, you're going backwards. So if your family is not in the role of investing the money and growing it actively, not like index funds, that type of stuff, right? That's very passive, and that's not really investing, in my opinion. You're trying to teach how to do due diligence on deals and people, right? It's a lot more active approach from that perspective. You're not the one swinging the hammer,
right?
You're not the one running the business. You're not the one renovating the units, but you're the steward of your own investment fund, right? That may not be for everybody, right? But that's kind of when you're getting on those top levels of the wealth elevator.
Right.
And I never realized that this was a thing until, earlier on when we started to buy apartments from these wealthy people. I'm like, who are these people? It's like 200-unit apartment complex, and there's 6 of them in their family. Who are these people?
Right.
Well, those people who, over the generations, they built up this substantial worth, and now their kids are taking over it, and sometimes they make bad business decisions and sell a good asset to us for a lower price that they probably should.
Right, because they're bored or they want to do something else or whatever.
I mean, I had a situation like one of the places we like is like Huntsville, Alabama, right? I mean, not to say
not too far from here, a couple hours.
Yeah, not to say that's good in the future, right? Because I don't give any investment advice, right? But the last 5 years, it's been amazing, right? I mean, it's increased. It's surpassed Birmingham. It's the most populated city.
And a big part of that is because of the federal government, right? There's a military base there. There's actually, for people who don't know, there is a NASA facility in Huntsville, Alabama.
Yeah. Don't talk about it. Yeah.
But and there could be other things that will be moving there, right? And so it is definitely a booming market.
Yeah. Yeah, I say that jokingly, but yeah, most unsophisticated investors, they just want to invest in Los Angeles.
Right. They're going, Alabama? Why would you invest in Alabama?
Yeah, exactly. Like, I mean, like, maybe some people who are really into like tech investments, right? Like Y Combinator and Bay Area is the epicenter for that. But to me, you're overpaying because it's such a rich ecosystem.
Right.
I would rather go and look for deal flow in Seattle or somewhere else, right? It's high quality, but not the sexiest place where you're going to overpay. I mean, you go to Las Vegas, you're going to pay $17 for a beer these days. Kind of the same concept, So yeah, I mean, that's, Alabama, right, is a market that we like. But I kind of forgot what I was going with that, but
We were talking about good places to invest and and places that people just don't even look at or look for.
yeah. So those are the kind of the places that we like to target. Or I was saying, where I started to meet these people, like we bought a property in Alabama from this family, and
Oh yes.
the kids the kids were taking over. The parents were dying, right? They're older, and the kids were taking over, and they didn't want the Huntsville property. They wanted the
Right,
Miami
because it's
property.
not the sexy place to be.
Yeah, they wanted to show it off to their other second, third generation wealthy friends that they had the Miami apartment, and I'm sure it was beautiful. Not the little
Costs 4 times as much.
Yeah, probably 4 times as much for a unit. Like we were paying like $50,000 per unit in Huntsville, and probably $300,000 in Miami is what they were at.
And it could get washed away.
Well, there's insurance for that, but yeah, there's, I mean, these are commercial properties, right? So you price that in, right? You price that in as an insurance line item, which is, the way institutional investors look at these types of investments, right?
And if somebody doesn't have hurricane insurance and they're down there, there's a big red flag.
Well, a lot of times you can't, right? A lot of times
because it is going to be an area that you're going to have a lot of claims.
Yeah. But I get, like, my point was, there's a lot of wealthy people that their kids are taking over, and they're just not very sophisticated, and you can take advantage of it. But you know what? It kind of opened my eyes to, like, well, there's these people that are on this level of the wealth elevator still there, right? They'll get better, but almost they can't miss at that point.
Right.
But I had never had exposure to that type of class. And so, like, again, a lot of these things that I put into the book are things I've seen myself or progress through myself. And I kind of just wanted to point it out, like, hey, this is how these wealthier people invest, but that may not be where you are at.
Right.
now.
Right. Yeah. And I love that you talk about educating the kids. I have guests on that, and we've talked about this before, because the kids are not taught this. I mean, they're not even taught the basics of having a checking account. And, I was dealing with somebody the other day, and I said, okay, I need you to send a check to here. And he said, I don't have a checking account. And I'm like, what do you mean you don't have a checking account? And he says, oh, well, I have a bank account. He said, but I do Zelle, I do all that stuff. And I said, we need a check. And so he had to go get a money order, right? Now, it was obviously, we were a little backward that we needed to check. But yeah, kids are not taught the basics of finances. And so when they get older, they've got a good job, they've got they've got money to invest, they have absolutely no idea what to do.
Yeah. I mean, they certainly don't know, like, the nuances of looking at a deal, vetting the people, sitting down with them, really deciphering what's the BS from the sales fluff.
Right.
Or, running the numbers and looking, is this a viable business? Like, and then operating said business. That said, a lot of wealthy families will give real estate to their kids because it's, quite honestly, the easiest business out there to run.
Yeah, because they've hired somebody to be their property manager or whatever. And
Right. Or maybe you don't even need a property. And if you got a paid off property, I mean, it's like playing the game on easy mode, very easy mode. And when you have money, it's easy to stay on top too, right? As long as it's working for you. But that it kind of illustrates, like, it to me, it's frustrating because one of my values is, like, what you have, you try to be the best steward of it. You try to maximize it as much as possible.
Right.
If you had, $10 million, you could grow that pretty well, and you could take the money and, if you wanted to do charities, etc. But you could buy more investments, do better things with it, operate it better. I think that's kind of where people call it greed, right? I call it more just being a good steward of the money and not just sitting on it and just I don't know what people drink pina coladas and watch the sunset, you know.
But as you mentioned, they can be philanthropic. They can start their own foundations. I was talking to someone the other day who she's doing well. So she started a foundation. She started a family foundation, and it gives scholarships to underprivileged kids. You know, and because she has investments, it's not like she has to have $1 million in the bank for those scholarships. You know, it's just kind of a rolling type of thing.
Yeah. And we were talking earlier in the show about, you know, a lot of people are stuck in that rat race, right? You're on the hamster wheel, and you're always just trading time for money because you haven't yet gotten to the point where your investments are churning off income on their own. And until you can get past that point where you don't have to go to a job, you don't have to pick up that client call. Yeah, to me,
I love it. You call it the golden handcuffs.
Yeah, it's a different part of. Some people crumble and they lose purpose at that point because they derive their power from their business or their job. But you know, that's
them.
Yeah, second to third floor of the wealth elevator. Essentially, that's kind of one of the things that come into play.
Right. You know, and it is like, you know, like we've been saying, it's everybody's personal choice. I mean, you know, I know people who they don't want to invest. To them, the 9 to 5 is the thing. But then they get old and they retire. You know, and then they're worried, right? You know, how are we going to get by? They might have done the 401k, they might have done other things. Well, why not have been building it up before so that it's already taken care of?
Yeah. And I think what I'm big on and like what I talk about on podcasts and the book is like we want to teach people how to hunt for food.
Right.
Whereas Wall Street wants to confuse you and make it seem like it's very confusing. So you're just like, I'm just going to go to Safeway, you know, buy it from you.
Right.
Where I'm like, you know, yeah, you got to be careful with this stuff. Like you cannot be a dummy for sure.
Right.
You know, not everybody should do this. A lot of people just don't have the business sense. But since we have a lot of business owners, right? I mean, I assume that there's some intellect there that can apply to this, right? You can make decisions where it's not your incomplete data and there's a risk involved. But, you know, I think people should have confidence that, you know, if you kind of look at basic things like rental properties, you can understand it, right? I mean, a lot of us have lived in apartments or lived in homes before and paid rent. So we kind of understand the business. And it's not a hugely dynamic thing or like other businesses where, oh my God, AI came over and my total marketing channel shut off overnight, right? It's not like, not a business like that. But if you don't get started on it and start learning, you know, you'll never get more and more sophisticated. So I think it's one of the last frontiers where people could get involved in this world and get better at it. And that's where I say like, hey, just start learning, you know, and learn how to hunt meat in the future and then teach it to your kids and keep it going, keep the family legacy going. If not, it's just going to go to zero on the third or fourth generation. But that's, you know, some people don't have kids, so maybe they don't care. But yeah, you know, like I think that is what society wants us to do is just give our money to the big institutions. They take all this money in hidden fees, etc. Or, you know, pharmaceutical. Hey, just take this pill. Don't worry about it. Don't, you know, we got it. Right.
Right. So talk to us more about real estate syndication. Exactly what is it that we're talking about?
Yeah. So the analogy I like to use is like an airplane. And, you know, airplane is kind of like a venture, right? Plane takes off. In the airplane, you have the cockpit where you have the general partner sit. Sometimes it's one person, sometimes a team of maybe 5-6 people, right? These are your general partners. These are the guys who sort of do everything. You know, most times it's a team, right? Where they'll find the deal, they'll get the lending, they'll operate it, they'll send out distributions, they'll manage it all. They'll obviously be incentivized to do it. Most cases, they'll be incentivized when the deal goes well, right? So this is why every deal is structured a little bit differently in the paperwork. But in Coach and Airplane, you know, you have all the passive investors, right? And I don't know about you, but when I get on a plane, whether you're first class or coach, you get in there and you go to sleep and you
Right.
nap.
We trust that they're going to get us to our destination.
Right.
Mhm.
Because if the plane goes down, I mean, we all kind of go down together.
Right.
But now what this does is allows you to diversify in, you know, dozens and dozens of different planes, right? And different types of planes too, right? Like I mentioned, different asset classes, self-storage, multifamily, buying businesses, CPA roll-ups, all kinds of things you can invest
Right.
in.
Right.
The important thing is more directly, right? Through this method and cutting out the big middlemen.
Right. And there is risk. I mean, there's always going to be risk. If you have 10 airplanes, one of them might have a problem. You hope not, right? But it's and that's where it pays, again, as you said, to be educated, to know, what am I going to do? All of these various things, and just make sure you know what's going on.
Yeah. So we have on my website a lot of education on people learning how to do due diligence on these deals. Ultimately, I think you got to pair that with community and an ecosystem, peer group, right? Like I think you need to have at least 5 accredited investor buddies that you can call up and get feedback on.
Right. What do you think about
something.
this?
Yeah, and I think that's the formula. Right? Peer group, community, and a little bit of education. And then, of course, you got to start doing it, right? You don't learn anything by just sitting around and reading things, watching videos.
Right.
You got to kind of do it. But I think you start to realize, just like, anything else, there's always like kind of a shadow community that quietly is doing something, that you want to do. You just got to find that ecosystem.
Right. And you have those communities. You've got your club. Talk to us a little bit more about that.
Yeah, we actually this weekend we're going to be in Hawaii doing our annual retreat.
Oh.
We bring people out. We do it's that we do it because it's cold everywhere else.
Yeah, everybody wants to go to Hawaii.
Yeah, it's a little bit cheaper this time of year in January.
Yeah, because everybody traveled in December. Yep.
Yeah, but this is we kind of create that environment where people can interact with people in a relaxed, immersive setting and really talk about like finance is a very private, right? It's divulging. Like most people talk about sex with their friends and family,
right?
With
but they
partner.
don't talk about what they did with their
Yeah. So to me, it's crazy, right? I mean, in our ecosystem, it's the opposite, right? But I think I think that's our sauce is we filter the right people in. And everybody's kind of on that same level, and it's not like a showboaty thing. It's like we're all on these sets of floors, and we all kind of know the plan to get to where we want to be. It just takes time. It's not a get rich quick thing, but also it's I think, and it's I've kind of keened into this the last couple of years. Like the people who come are they're most of them are in their 40s and 50s with kids,
right?
Maybe that's because I got a family. That's what I kind of personify. But there's like a lot of similar value sets, right? Being a good steward of wealth, not wasting things.
You want to be able to put your kids into college, all of those various things.
Yeah, you don't. These guys, they don't stay in the Four Seasons below $1,000 a night. They go to Hilton. They use their hotel points.
Couple hundred a night's okay.
Yeah, well, Hawaii's 5 times or $500 here, but that's reasonable for this area. You have a really, really down to earth people, which is why like the common thread is we're all first generation multimillionaires. Our parents didn't give us this money,
right? You've earned it.
Yeah, I mean, they set us up to go to college,
right?
For that, right? But the first generation, there's always a family. In some families, that is the first multi-millionaire, the bona fide multi-millions. Like, in Hawaii, I mean, everybody who owns a house is a millionaire.
Right.
You just buy a house.
Because of property values, right?
Right. That's why we say multi-millionaire, because $1 million isn't what it used to be. But that's, like most people, like take a doctor, for example. I mean, a guy who's in his 50s, most doctors in their 50s are about $1.5 million, $2 million net worth, right? Which is dumbfounding to me, right? A lot of them are really horrible budgeters and savers.
Oh, yeah.
Yeah, but people in our ecosystem who are doctors, same age, that have been doing this for not too long, like 5-6 mil easily, because they're paying a lot less in taxes and they're investing in a different mechanism, and they take their phenomenal salary and just really maximize and get everything they can out of it from an investment point of view. So
and then when they burn out, they can retire at 50.
Yeah, I mean, that's what most of them do, right? Like they hit that third floor of the wealth elevator and then they don't need to trade time for money, and they can do with what they want to do. Although they usually is alignment in some type of vocation, right? Most people will say, well, I'm not looking to leave my job or change my business.
But I'm going to volunteer doing something or,
I'm just do it 20 hours a week, right? Or not work with these types of clients. Yeah.
I love that. I love that. Well, Lane, we are almost done. This has been absolutely fascinating. But for people who went, oh, this sounds really cool, but I'm very confused, or I don't, right? How do they find you, and what are the services that you provide?
Yeah, they can check out my podcast, Wealth Elevator, but what I would really suggest is check out the book. I know there's an investment to people's time, but if they read the book and they write a review and they send us a screenshot, we'll hook them up with the PDF version and then the audiobook version.
Cool.
Team at thewealthelevator.com there. But yeah, if you read the book, if you guys are accredited investors out there, yeah, I'll hop on a call with you guys and we can talk to your guys' situation.
Right. And you mentioned, and I was looking at it, you've got a lot of great resources on your website for people to kind of look through and go, oh, okay, now this is making more sense.
Yeah. I think the problem is a lot of people just are not aware of these types of tactics.
Right. Again, they think it takes $1 million.
Yeah. Or best thing I can do to mitigate taxes is a 401k or a Roth IRA.
Right. Because that's what they were taught.
Yeah. Yeah. But the problem is exposure, right? Like if you're around people who, you take financial advice from people who are financially free. Typically, they're not working in the cubicle next to you.
Right. Yeah. Well, I mean, there's the saying that we are the sum of the 5 people we spend the most time with.
Right.
So who are you spending time with?
Right. Problem is, I mean, easier said than done, right? Access to these people is difficult.
Right. And like you said, people don't want to talk about money. So that makes it even more complicated.
Yeah. And that's why, the call that I do with people when they come in is twofold, right? I have to kind of filter the right people into the ecosystem too. I'm the gatekeeper.
Right. Yeah. If somebody's making, $50,000 a year, maybe not.
Yeah. Or the guy who he bought a business and it just happened to be in the right sector and he sells it for $7 million, and then, he thinks he's the hottest things and sliced bread and blowing the money on yachts and fancy homes, and maybe not a good culture fit for that person.
Right. Because it's like you said, you need that community, and and I think that is so important to build the right people in it.
That's correct. Yeah.
Right. Well, oh my gosh, Lane, this really has been absolutely fascinating. We'll have all the links in the show notes. And so people can find your website, they can find your book, and I will put a link in there to your LinkedIn profile, because you've got a great profile. But as I said, this has been absolutely fascinating. We do encourage people to reach out to you to read the book, and so we want to do that. But do you have any final thoughts that you want to leave everyone with?
If everybody just bought a rental property or two and milked it over 20 years, I think you probably find a lot of people not really working past the age of 50, and therefore society would crumble. So we don't, governments and societies don't want that to happen. So there's a reason why they want you to go to these normal channels. But, I think if anything, don't take it from me, take it from the other people out there in the ecosystem, and, think for yourself is what I say. Right? A lot of this is just baked into numbers, right? Like if you buy an apartment for $60,000 that rents for $700 a month, and you can put a new fridge, appliance in there, bump it up to $700 or $850. And, it's just math at that point, right?
Mm-hmm. I love it. I love it. Well, folks, I do encourage you to get Lane's book, to look on his website. And as I said, we've got all of those links on there. I'm Deb Creer. I've been having so much fun and learning from Lane Kawaoka. And until next time, everyone have a great day.
Tune in for our next program for even more trends, best practices, and techniques for how to make your business a success. The Business Power Hour, hosted by Deb Creer, is proud to be part of the C-Suite Network.